In this video, I'll be sharing some highly profitable trading strategies solely based on price action. These methods have consistently shown success throughout my years as an active trader, and I'm eager to walk you through them. In this strategy, we examine the market's history to pinpoint crucial support or resistance levels. These areas represent points where the price has historically encountered obstacles when attempting to move through. In the meantime, we need to closely monitor any sudden break of this level, both upward and downward. These movements should coincide with the formation of relatively large candles characterized by substantial bodies and minimal wicks. After this, the market will likely enter a phase of consolidation or range, which could last for some time. However, it's crucial to avoid entering long or short trades until the market achieves stability near the breakout point. This could mean waiting it out until you see any signs of a reversal around that area. While using this strategy, closely observing the price action in that area can offer significant advantages. For instance, in this scenario, following an extended downtrend, the emergence of higher highs and higher lows could signal a definite reversal and the beginning of a bullish trend. Or, for those of you with a keen eye, spotting the formation of this bullish QM pattern can be another reliable sign of a potential reversal. Another essential aspect to consider when employing this strategy is that when there's a pronounced shift in market sentiment, it often leads to a prolonged trading range. Consequently, it's advisable not to set unrealistic targets for your trades. Opting for noticeable support or resistance levels from the past, or even liquidity zones as potential take-profit levels, might be a more realistic and viable choice. Moreover, keeping an eye on various technical analysis elements could prove beneficial. For instance, incorporating a trend line that aligns with the breakout point can significantly enhance your trading strategy. We all know that Bitcoin trades round the clock, but the CME futures market operates on a different schedule. When the market closes on Friday and reopens late Sunday or early Monday, a gap emerges, reflecting the difference in prices. Some traders view CME gaps as potential indicators, expecting them to eventually be filled since the market often revisits these levels. However, CME gaps offer trading opportunities beyond simply filling the gap. Often these gaps prompt the market to enter a prolonged consolidation phase. This offers traders who prefer range-bound markets the chance to establish multiple buy and sell trades around the boundaries of these ranges, especially in lower time frames. They utilize the opposite side of the range as their potential targets. While the filling of CME gaps is quite common, it's not a hard and fast rule. Some gaps, like one that occurred in March, may remain unfilled. This prompts many traders to monitor that zone closely if the price ever reaches that area in the future. Also, it is possible for these gaps to occur on days other than weekends. When such gaps arise between consecutive weekdays, I usually avoid looking for trading opportunities unless the gap is significant. Here, we can observe a gap between Monday's closing price and Tuesday's opening price. Due to the gap's significance, a trading range has emerged, potentially offering reliable buy and sell signals. Similarly, here we see the same occurrence caused by a substantial gap between Thursday and Friday. After a consolidation phase, the price swiftly moved toward the gap, marked by the formation of a sizable bullish candle. Most traders see a break in a trend line as a sign that market sentiment might change, so they instinctively prepare for that shift. But it's imperative to realize that while this approach is common, it doesn't always guarantee reliability. Trend lines can be manipulated, and from what I've seen, this happens quite often. Sometimes these trend lines appear to break on one side, but after a brief pause, the price action reverses its course and continues following the trajectory of the previous trend line. You might think we can always trade these trendline manipulations, but in reality, we need more confirmation to steer clear of falling into another trap, something we'll delve into in the following strategy. The third strategy harnesses the power of a trend line in a higher time frame, when the price retraces back to it, by forming a reversal pattern in the lower time frame. Let me paint a clearer picture with an example. Here the pair's price has declined steadily on the 4-hour chart. Using these three fractals, we draw a trend line and patiently observe how the price behaves as it nears this line for the fourth time. Upon reaching the trend line, the shrinking candles pattern clearly indicates momentum loss in this time frame. But as I mentioned before, we want additional confirmations from lower time frames when the price gets near the trend line. When we shift to the 15-minute chart, we notice the initial signs of a potential reversal as the price enters a wedge pattern. This pattern holds significant weight in terms of reliability, as I've frequently highlighted its strength in several of my videos. By merging these two solid clues from different time frames, our inclination strongly favors the selling side. If you'd like to enhance your analysis, consider adding the RSI indicator to your chart. Pay particular attention to any divergence between the price and the indicator, which is distinctly noticeable in this situation. Taking a look from the perspective of less experienced traders, they could misinterpret the trendline break as a signal to initiate a long position, assuming the previous trend will persist. But those who have a bigger picture of the market in mind await the wedge pattern to break downward before initiating a sell trade. In my experience, trends following this occurrence tend to be extensive and offer traders favorable reward-to-risk ratios. So, from now on, whenever you notice the price nearing a trend line, consider shifting to a lower time frame to check if a reversal pattern is potentially unfolding. This holds true even when it appears that the trend line has been broken. The next strategy proves helpful when the price is trending above or below a specific trend line, and then suddenly surges, creating significant distance from that trend line. After a few minor swings, it promptly retraces back to the trend line in just one leg. In this scenario, we're not necessarily anticipating a significant trend reversal. Our goal is more focused on seizing the second leg of the pullback before others catch on and before the opportunity closes. To initiate a short trade in a bearish scenario, it's essential to spot a pin bar and confirm it with a subsequent bearish candle close to the trend line. Yet, a more cautious approach involves waiting for the price to break the trend line and then pulling back to it. It's imperative to bear in mind that fulfilling these conditions is necessary when employing this strategy. Sometimes, despite everything seeming aligned for an order based on this strategy, the subsequent requirements might not unfold, causing the price to persist in following the trend line's direction. The second leg of the major pullback doesn't always match the length of the first one. Sometimes it is longer or shorter. However, in my experience, it's rarely shorter than 0.618 times the length of the first leg. Remember, the way the price approaches the trend line holds great significance. In this example, you'll notice that rather than swiftly retracing to the trend line in one leg, the price reaches it in two legs with considerable compression. In this scenario, unlike the prior one, we typically expect the price to bounce back from the trend line and resume its previous trajectory. If you found this information valuable and gained new knowledge, please consider liking the video. Thank you for watching.